Okay, so we'll start on that end of the board and work this way. Inventory. First thing you need to know about inventory is how things flow through your inventory accounts. Okay. So make sure that you understand the idea that if you have a manufacturing company, which Illinois Tools is, so that's kind of a given, you're going to have raw materials, work in process, finished goods. Those are the three types of inventories, and then you have cost of goods sold on your income statement. So all three of these would be listed, and typically what a company does is on their balance sheet, they'll call this inventory, and then in their notes they'll tell you how much is in each one of those three accounts. Okay? If they have a contra account for obsolescence, it is usually it usually pairs with the finished goods, but it can be paired with the all three inventory accounts. But in general, you can say, oh, if there's obsolete inventory, it's the contra to finished goods, but you kind of get the overall inventory numbers. Okay, so what happens is raw materials, you'll have beginning, obviously, and you end up purchasing raw materials. Typically, these purchases are paid with accounts payable. We don't pay them in cash, we buy them on credit. So you buy your raw materials, and then you use your raw materials, and when you use them, they go into work in process. So you take it out of raw materials and you put it into work in process to be used. What also goes into work in process is you will also add in depreciation, labor, or salaries, utilities. These are all normally expenses that you simply capitalize as inventory. Why do we do that? Well, hey, I've got to use each one of these items. I've got to use the equipment, and using the equipment means I'm using depreciation. I've got to have labor. I've got people putting my products together, so that's salaries that I'm paying. I've got utilities that I have to pay to run the machine, the electricity. So all those expenses, I get to capitalize them or make them into an asset. We just throw them directly into work in process. Okay? It's kind of a simplistic way of looking at it. But the idea is, instead of doing a journal entry where you would debit salary expense, credit salary payable, you're going to debit inventory and credit salaries payable. You're going to debit inventory and utilities payable. You're going to debit inventory and credit accumulated depreciation. Okay. So that's kind of what's happening there. Once you have all that, as it is finished, when you finish work in process, it goes into finished goods. So once you've transformed the raw materials using labor and overhead into a finished product, you move it into finished goods, and then you can sell it. And once it's sold, you move it into cost of goods sold. Okay. That's the flow of kind of manufacturing. So technically, you can work your way backwards through each one of these and figure things out. Because your cost of goods sold, you'll know what was sold because it's on your income statement. And then we're going to again have a beginning and ending balance. Well, guess what? If I know what my beginning and ending is, because the notes tell me what my beginning and ending is, I can solve my finished goods. Once I do that, I know what was in work in process. Okay? I would have to give you these numbers, or I would show you where to find those numbers. But once you have that, you can figure out what did we actually use. Once you figure that backwards to use, because then we're going to have beginning and ending. Once you figure out what's used, you can then figure out what's been purchased. And once you figured out what's been purchased, you can figure out the cash that was paid. And again, if we had a statement of direct cash flows, that's the second line on your statement of cash flows, cash paid for inventory. Again, these are the nitty-gritty building blocks of how things get into the financial statements. If you have a reserve for obsolescence, what you're saying is I estimate some of my finished goods will go bad, and therefore part of what I have as cost of goods sold is the portion that will also go obsolete as well as what's been sold. You could also have a reserve for theft. You could have reserve for, theft if you're someplace that things disappear on you quite a bit. Things walk away, okay? And then, so your obsolescence, that's what's happening. And then when something actually becomes obsolete, guess what? You take it out of there. So again, this works, if you think about it, this works exactly like the accounts receivable scenario. I've just added an account in there for obsolescence. Just kind of stuck it right in. And that's what we did with Catepillar. That's what Catepillar does, is that we kind of flowed through, and then I had you as a separate assignment to kind of look at what happens with obsolete inventory. But that was the purpose of doing the Catepillar one, is so that you could see how everything flowed through.
So, work in progress is sort of like this ghost account because it's not, but it's a liability. Right?
No, these are all assets. All three of these are assets. Yeah, it's work in process. It's technically, think of it this way. All of these items can be converted into cash. If you had to have a fire sale, you could sell your raw materials to another business. Even your work in progress, you could either finish and sell, or you could sell it partially completed to somebody, or your finished goods you can sell. So each one of those are going to be assets to you. Yeah.
So the estimated for obsolescence is already in the cost of goods sold in the income statement?
If it would be an added amount, okay, but yes, you're right. If your total cost of goods sold, so what we did in Catepillar is we said, oh, if this is my total cost of goods sold, and we know a certain portion of it's the estimate for obsolete, the rest of it must have been what was sold.
So the obsolescence, that might be in the notes, but it's going to be already part of that number in the
Right, it's already part of that. So cost of goods sold can include not only what you sold, but what walks away in terms of what has been stolen,
Right.
as well as something that has gone obsolete. And all you see is cost of goods sold.
But that's just an estimate, like the actual amount is already in the
Right,
in the
it's already,
inventory.
right, exactly. So and again, like the other reserve accounts, as long as your estimate and your actual are pretty close, it's good enough. Yeah.
So if you have a net inventory, what is the breakup does? What is it? Like, why do we have a breakup as well? Even though it's all aggregated with assets.
Right. For the most part, what it tells you is at what stage things are at in the company.
Okay.
So a company that has a lot of finished goods, but maybe in an industry that's rapidly changing, for example, computers, you take something like Gateway or Dell. If they've got a lot of finished, Gateway, are they still even around? No, they died, didn't they?
I think they're gone.
Okay, Dell, Apple, whatever. If they've got a lot in their finished goods and they're in a rapidly changing technology, that should make you go, ugh, because are they going to be able to sell all that? Okay. On the other hand, you may have a company that is in a big growth industry and all their stuff is in raw material and work in process, which is great, but you have to ask yourself, are they going to be ready to sell things because they still have to complete it? So the more you have over in raw materials and finished work in process, what you have to recognize is they still have to make the finished goods. Now, in a computer industry, that would be great. You'd rather have them have the parts that they can then assemble just in time to sell to a customer than you would rather have them have it sitting all in finished goods. So part of that is just trying to tell you where is their money wrapped up in inventory.
And so my interest would be looking at the finished and the cost to see how much
Yes.
has been finished and how much has been.
Right. In general, it is. What we're really interested in is those finished goods and the cost of goods sold, because everything else has to be finished before you can sell. Right. John, yeah.
So this is was, this is still products inside of that workflow that's right there.
Yep.
And at the end, it's merchandise. So
Yep.
the retailer has that in the final inventory too. So it's
Right.
all, it's still product, whether metal
Right.
stage it's in.
So what we said was, yeah, exactly. If you are a manufacturer, you're gonna have these three types. If you're a merchandising, if you're Macy's or Nordstrom's, you're buying finished goods and your inventory is all finished goods and you just have that one. They're all inventory. The question then becomes, this just tells you the flow and where things are at. And when you're talking manufacturing companies, that can make a difference. Okay.
Illinois Tool Works is a manufacturing company, right?
I believe they are,
So
yes.
we'll-
Yeah, so that's, just saying. You're getting the right,
can get.
you're getting the right idea now, aren't you? It's all, I told you, it would come together at the end, even if it is, how does her brain work? Not necessarily about accounting, but how does her brain work, yeah.
The note that you have in the middle for depreciation, labor,
Yeah.
I missed it, what you said about that.
Yeah, when you're making goods, there's, we talked about overhead. A lot of people, you'll talk about materials, labor, and overhead. That overhead is things like depreciation, utilities, anything that's in your factory is gonna be considered overhead. And so what happens is if you have a factory, you don't expense all that stuff as SG&A, you put it into your inventory, which is gonna make your cost of goods sold a lot higher. Which is why you have manufacturing companies, they have sales and then their cost of goods sold number is huge. The reason why is it includes all the depreciation, all the utilities, all the stuff that other companies would put into SG&A. But because they're making a product, it all can go in there. Their office stuff cannot. So in other words, if you've got a factory building and then you have office support is gonna be SG&A. But anything that's happening in that factory can go into the product, okay? Now what happens when you hit the fall is they'll talk a lot about how you allocate this overhead, and you guys probably know this a lot, a lot of you may already know this. How you allocate that overhead is gonna change the price of the product, which is then going to change what you can sell it for. So in other words, what happens is companies that just kind of throw everything in there and say, all my products are equal, I'm just going to assume that I'm allocating overhead equally over all the products, may be overpricing some of their products and underpricing other products. Another way of doing it is what they call ABC accounting, which, and you probably heard the genre about drivers, cost drivers. What's driving the cost? The idea there is to trace the overhead based on, well, where, what part of the process, did this come from? So what product should bear most of the cost of that? When you do it that way, you end up with different types of product costs, which means you can price better. So the better you are at allocating this overhead directly to a product or product lines, the better you are going to be at pricing. And the better you are at pricing means that you're going to be able to do, compete in a much better, faster. And that's what you spend part of. You'll do a lot of that in the fall when you take managerial accounting and talk about how you can do that.
So when we're looking at, building blocks versus a 20,000-foot view, right, bird's eye
Right.
view of this whole process, and you were to ask us to describe, if we were going to list the accounts for Illinois Toll Works for their inventory, what kind of inventory accounts do they have? Now describe how it affects. Are we just going to talk about how it flows through each one of those accounts?
Yes.
Okay.
I may ask you more specifically saying, can you figure out?
You don't have
No,
to.
I don't need to do that. I can
No.
just keep it at 20,000 feet.
Thank you.
Right.
But if you were
Do
to
the right
ask Rob,
thing.
what would you ask?
I said, I could say, given how much they have in cost of goods sold, can you figure out, basically how much cash they paid for it? You'd have to solve backwards to get to what did you purchase originally? That's that type of thing. So I could ask you just describe this flow, or I could say, given the cost of goods sold, can you tell me how much did they purchase, how much did they use, how much did they finish? I could ask you for each of those component parts along the way, depending on which one I wanted to torture you with. Yes.
So, those labor costs and salaries, and those are capitalized, right?
Yep.
You don't show up in the cash flow expense statement, right?
Right. It's all going to show up in inventory.
Inventory. So it's showing up in the bank. So from an income tax perspective, what is the gains advantages of it?
Okay, from a tax perspective is entirely different, because from a tax perspective, you're gonna get deductions for that, but that's gonna be on your tax return, and tax law is different.
Okay.
than the financial reporting.
So why can't they, why don't they just put it in my as expense rather than putting this in,
Oh,
as
because
a-
most
what's
companies,
the point of doing it?
because most companies, if you look at an income statement, most companies, okay, you're gonna have sales, and then you're gonna have cost of goods sold, then you're gonna have SG&A, other net income. What most people expect to see is, okay, so this is gonna be 100%, they would expect this to be the next largest, and then SG&A, they want to be, reasonable, and we have 20%, so we've got 91, so I've got net income is 9%, okay? So what they're saying is most people, when they're analyzing companies, are gonna look at, are you controlling the cost of your product, and are you controlling the other overhead, or the other general administrative expenses?
Okay.
So if I've got a manufacturing plant, I don't wanna report it down here, because then it's gonna look like my
Right,
SG&A is way out of control,
Okay.
when in reality, every one of those things is necessary to produce the
Produce the
product.
cost. Okay.
On the other hand, you also might have a company where this company has 70% in cost of goods sold, but its competitor maybe has it down at 60%. So the question is, why are they at 7 where the competitor's at 60? One is the unions. The union, if you're in a union shop versus a non-union shop, your labor differences can be huge, and that can be doing that as
So
well.
purely from an, to keep the SG&A cost perspective lower,
Right.
they try to calculate as much as possible so that it doesn't.
Right, exactly, yeah. That's what you're gonna do. Now, if you look at two companies, and one company has, let's say, this pattern. Notice they're both making 9%. The question you should be asking is, exactly how are they splitting that? Are those really the same thing? Why are their SG&A costs really high on one and low on the other? They may not be they may not be doing this, they may not be allocating as tightly as the other one. So a lot of times you kind of want to look at that. This is also the Walmart versus Kmart situation. Yeah, Walmart tends to have a really high cost of goods sold, but has very little SG&A because they don't have any stock in their shelves. You ever walked into a Walmart? There's nobody at a Walmart half the time. That's not quite true. Okay, and they're also using non-union, so those costs are small. Versus Kmart, actually this would be Kmart. Kmart's going to have a lot higher, this is Kmart SG&A because they're going to have a lot more employees walking around, but their cost of goods sold may be different. So part of it may just be where they're putting things.
Okay.
And that's also an analysis you do a little bit more in the fall, because you're actually looking at where do I put these costs and what difference does it make in budgeting and in pricing and my decisions to whether or not to produce a product or not to produce a product. Okay, so that's the flow of goods. That's the first part of inventory. The second part of inventory would be, how do we come up with the numbers? For that, what you want to do is you want to focus primarily on just finished goods versus cost of goods sold. So the idea here is I'm going to have a beginning inventory, I'm going to have some sort of purchase or finished goods coming in, and I'm going to sell it. What is sold goes into cost of goods sold. Okay, now, this is where LIFO, FIFO, and average come in. Yeah, so LIFO, remember, is last in, first out. First in stays there in ending inventory. FIFO is first in, first out. Last in stays there in ending inventory. And then average is average, okay? And whatever's not in ending inventory has to have been sold. So we have LIFO, FIFO, or average here. That's how we calculate those numbers. So what you're doing when you do those LIFO, FIFO problems, which I had you do in the book, and they'd say, oh, you have a beginning number, and here's the purchases at this price, and whatever, they'd say, if they're using LIFO, what's the number? What they're really doing is they're saying, because remember, it was always beginning plus purchases minus what's been cost of goods sold gives me my ending inventory. And the question is, you're using LIFO and FIFO to figure out one of those two numbers. And what we've always said is whatever's there has to be either still in inventory or it's been sold. It's gotta be one place or the other, okay? What you need to remember is if you're calculating ending inventory, it's the last in, first out means the first good in stays there in ending inventory. FIFO means the last in good stays there in ending inventory. Only in accounting would you name something an inventory method and you're trying to do the opposite. The inventory method is last in, first out to calculate cost of goods sold, not what stays there. But we call it an inventory method. So it's better to say LIFO, FIFO, and average is how we calculate cost of goods sold. Everything else must be ending inventory.
So FIST, I'm sorry, I just didn't catch what that stands for.
First in stays there
Okay.
in ending inventory. So a lot of your homework problems in this chapter were about, and even in the receivables chapter, were all about, most of your textbook stuff, not all, but a lot of the textbook stuff is, how do we actually come up with the estimates? How do we actually do these numbers? That's that building block level. And what I want you to kind of do is then take that and say, okay, how does that, why do I care? I can calculate the number, but what does it mean? I'm trying to get you to then to see what it would look like in an actual financial statement. And so, yeah, you're applying LIFO and FIFO to figure out the number that's getting moved to cost of goods sold, the number that's staying in your ending inventory. You're going to have different numbers for each one of those. And that's the thing to remember, is you're going to have different numbers. And the way to remember it is, it depends on if price is rising or falling.